You're listening to Voices of Customer Experience. I'm your host, Mary Drummond, and on this podcast, we shine the spotlight on individuals who are making a difference in customer experience. We also proudly bring you the very best of customer experience, behavior economics, data analytics, and design. Make sure to subscribe or follow us on social for updates. Voices of Customer Experience is brought to you by Worthix. Discover your worth at worthix.com. We have with us today Assistant Professor of Marketing at Emory University's Goizueta School of Business, Dan McCarthy. Dan's research specialty is the application of leading-edge statistical methodology to contemporary empirical marketing problems. He received his Ph.D. in statistics from the Wharton School of the University of Pennsylvania, and his research interests include customer-based corporate valuation and customer lifetime value. Dan was co-founder and chief statistician at Zodiac, a predictive customer analytics firm, until it was sold to Nike in March 2018. Dan has since co-founded Theta Equity Partners to commercialize his research on CBCV. Hi there, Dan.
It's great to be with you, Mary.
And I wanted to welcome James Conrad, co-hosting with me again today.
My pleasure to be here.
Awesome. Well, I wanted to start off kind of with an introduction of you and your work. Dan, can you tell people a little bit about your background, where you started off and where you are today?
Yeah, I'd be happy to. Yeah, so my background is really kind of unique. I'd spent about 6 years working at an investment firm, kind of analyzing stocks and deciding whether or not their prices were fair, whether we should buy or sell them. After that, I saw the light and actually ended up going back for my Ph.D. in statistics, because statistics has been my true passion. But in the second year of that Ph.D. program, someone had said, you should speak with Pete Fader. I think you'd really get along with him. And it just so happened that we struck up conversation, and the rest is history. I basically made a pivot into marketing. And since then, I've been studying some problems that are basically equivalent to what he's been spending the past 30 years studying. So, let's make predictions about what customers will do, whether it's the orders they place, the amount they spend, when they're going to be acquired, when they'll churn, all of those. And really, what ended up becoming my dissertation was taking those sort of problems and then really bringing it back to what I'd spent the previous 6 years working on in finance, and just saying, is there any way that we can take these great models that have been constructed in marketing and use them to better inform the sort of valuation models that I'd spent all those years thinking about. And that became my dissertation. So, we call it customer-based corporate valuation, but really at its most basic level, it's just saying, let's make predictions of what customers will do. And ultimately that's telling us something about how much the firm is worth.
Awesome. Well, the feeling that I get from reading your material and listening to some podcasts that are available online is that what you've done in your career is combining, like you said, marketing with finances and the mathematical algorithms and numbers and models, and to give decision makers the power to back up their decisions with science as opposed to just intuition, which is what most of us in marketing do. Is that accurate?
Yeah, no, that's exactly the sort of thing that I'm hoping that this work will do within the marketing department. So we consider this to be a Trojan horse for marketers, even though it may come off to outsiders as being very kind of financially oriented. And I think part of the idea is to create a real kind of language that marketers can use to communicate with the CFO, who's ultimately the one who controls the purse strings. Right. So whether you're thinking about the latest customer journey plan or, the investment in customer experience, those are going to be, obviously very important to the customer. And the question is, can we translate those activities into customers staying around for longer, buying more, spending more when they're there, or, spending less, that the company has to spend less to keep them around. And, ultimately, this sort of work will allow those marketers to translate those investments into valuation lift estimates. That this is going to improve the value of our firm by X, and I can point to exactly where that's coming from. So I think this will be, hopefully very, very impactful for people within marketing.
This actually a concept that I went in with Gene Bliss, where we talked about how maybe one of the greatest pains of the customer experience market is CXers having trouble actually proving that customer experience in that case is a growth strategy as opposed to just something within marketing, and that there's actual true value, and correlating the bottom line with the customer's experience, right? So I feel like it's kind of the same thing.
Yeah, and I think, a step in the right direction are metrics like the Net Promoter Score, where you actually do have a quantifiable metric of, how happy your customers are. But I think even those, it really helps to be able to take it to that next level and say, obviously, I really want my customers to be happy with me, all else being equal, but all else is not equal. And I have shareholders that I need to attend to. Otherwise, they're going to boot me out. So ultimately, to take all of those metrics and then jam them into some sort of model for how customers create value for the firm is it just makes sense.
Yeah. Yeah, one of the quotes that you had, I think it was in the customer base corporate valuation paper, I believe, you said that marketing managers may resolve more of their uncertainty regarding future profits by learning more about what prompts customers to make purchases and less on how much these customers will spend there. I thought that was really interesting as the people listening to the podcast are trying to decide on customer journeys, as you talked about, and customer experience, and thinking about the drivers behind the decision rather than the value of the purchases themselves. And this is something that you've obviously looked into.
Yeah, and that I think speaks to the statistician in me.
Yeah.
that ultimately to generate sales, you need someone who's making an order, and then there's an amount of spend associated with that order. So rather than treat those two processes as one, I say let's predict both of them. And ultimately, you end up with much better overall predictions of what sales will be anyways. So, yeah, I think that decomposition is very, very helpful.
Yeah. And in your work, Dan, have you isolated the impact of experience on customer lifetime value in relation to some of these other things? And what have some of the conclusions and implications that have come out of some of the work that you've looked at in relation to the experience that customers have and what's driving them to come back and stay, et cetera?
I think that's one of the most exciting unsolved problems that I have not touched yet. So I have not linked customer experience or Net Promoter Score or any of those other, measures that are currently really in vogue in marketing to the overall value of firms. Ultimately, the first two papers that Pete Fader and I had written, they really kind of laid that just ground level foundation for how we can translate customer activity into valuation estimates. I think, the exciting next four papers are going to be about how we can think about incorporating new data sources, incorporating things like customer experience directly into the model. Hopefully that means there's a real tenure case to be made here.
Yeah. Absolutely. Absolutely. And as you think about measurement, you mentioned NPS, and there are other ways of measuring customer experience. And in your teaching as well, have you developed some ideas around best ways to measure? Have you seen some great cases as you head into thinking about tackling this down the road in future papers? I'd love to get your thoughts on measurement techniques, either from academia or from the work that you've done.
Yeah, there's two that have come up. And so obviously there could be many more as we really kind of put our heads to the table to think about that paper. One is obviously Net Promoter Score is tracked oftentimes at the individual level. So you may not know the scores for every single customer, but you'll know them for some of the time. And so
Right.
it's a very interesting measurement problem of how you can then incorporate that kind of very weird data structure into the model. But there's a lot of appealing aspects there, that if you had a smart statistician tackle it, they could. So there's someone, I don't know if you know Rob Markey from Bain.
Mm-hmm.
Yeah, he's the one who's kind of spearheading their Net Promoter Score efforts over there. And so we're we've been speaking with him about kind of the relationship between CLV and Net Promoter Score. And I think the good thing is because Bain is really they're at the forefront of NPS, having invented it. That they have a great data set where we can look across potentially multiple firms and draw statements about how variation in NPS leads to better customer outcomes. So, for MPS, I think the data is oftentimes in the company's systems. It's just a statistical problem. Another thing that could be useful is through using surveys. So this is kind of more old school marketing research, but one of the examples that I had spent a lot of time studying myself was Blue Apron, the meal kit company that.
Oh, right.
Yep. And in 2016, they were the number one player. Between them and HelloFresh, they had 70% of the market. They seemed like they were dominating it, and obviously, things have changed considerably over the past year and a half. And one of the things that I had done originally, right after Blue Apron had stated their intention to IPO, I'd inferred that they had troubling customer retention. But to your point, I couldn't really say why. All I could say was, look, empirically, the customers are dropping off very quickly. And, only 20% are left at the end of 1 year. Only 50% are left at the end of a month. But recently there's been some additional studies that have been done, basically, trying to explain the why. And, I think surveys could be basically just another way that, we can kind of figure out what might have been causing the churn and allow us to think about potentially if we were to take action to stop some of it, what sort of improvement or lift we could expect in retention, and then ultimately, the value of a company like Blue Apron.
Voices of Customer Experience is brought to you by Worthix. If you're interested in customer experience, behavior economics, or data science, follow Worthix on social media or subscribe to our blog for the best content on the web. Dan, let me ask you, I've also heard you speak about this now getting into the customer-based corporate valuation. Can you explain a little bit about how the model works? I know that you've got two models, one that works for subscription-based companies and another one for non-subscription-based companies. Is that right?
That's exactly right. So we had one paper for the one setting, one paper for the other.
And if we can get into this, kind of almost baby stepping it for those who are not yet familiar with the concept and how this can maybe even be a game changer that kind of unites marketing with finances.
I think it will be a game changer. I think we're already starting to see it to a limited extent already, but I think 3 years from now, this will kind of just become how people do it. Mm-hmm. I think at the most basic level, any valuation model needs to make forecasts for what future sales will be. What are sales going to be in 2019, 2020, and so on and so forth. At that point, the valuation method that you use might be a so-called discounted cash flow valuation model. It might be a multiples method, but ultimately, everyone needs to come up with sales predictions. And all customer-based corporate valuation is doing is providing a mechanical, scientific approach, a data-driven approach to coming up with a better sales forecast. So, just kind of honing in on, say, 2019. If we want to predict, sales in calendar 2019, those sales are going to come from either customers that we already have that are buying new stuff, or it's going to come from new customers that I acquired in 2019 at some point during the year. And so basically it's almost like an accounting identity that I'm going to break down sales into a few processes. There's going to be existing customers, there's the orders that they place, there's the spend on those orders, and then there's the new customers that I haven't brought in yet, and then their purchases and their spend. And when you kind of sum it all up, you get sales. But ultimately, it's coming from customer acquisition, customer retention, the number of orders that customers place while they're alive, and the spend on those orders. Hopefully that's something that everyone they almost kind of have to agree on. There's no other way that sales can be generated at a customer-based business. So, that's where basically the two kind of tricky parts come in. One is, how do we model customer acquisition, retention, and spend? And then how do we do it when we have this SEC data? So if we wanted to do an analysis like the one that I had done for Blue Apron, or what Pete and I had done for the e-commerce retailers Overstock and Wayfair, we don't. I
want to get back to that later.
Yeah. we don't have the luxury of transaction log data. We just never get to see, that Bob spent $50, on January 1st. The only thing that we're going to get to see are these kind of quarterly summaries. So the number of people who were active in the quarter, or the number of orders that they placed, or the number of total customers that were acquired in the quarter. So, so I think that's where the methodological challenge comes in. But at a philosophical or just kind of, in terms of the pure accounting of it, I think hopefully that level, everyone can agree on.
So getting back into the e-commerce models that you were talking about, it's actually something that I find really interesting, and I was entertained by this story. I thought it was kind of amazing, the research that you did. So can you, for those of our listeners who aren't familiar with the story, can you kind of explain how the whole Overstock Wayfair thing went down?
Yeah, it's an entertaining story. It was a little harrowing as we were going through it.
Yeah, I imagine.
Yeah, so we put out this, we had finished the paper on subscription valuation. We had these valuation examples with Dish Network and Sirius XM satellite radio. And it had made its way through the Journal of Marketing. And so we said, all right, we checked the box on subscriptions. Now it's non-subscription. And for this paper, we basically had a data set from a large e-commerce retailer who had given us access to their transaction log. And so we played this kind of thought experiment where we said, imagine that we were to take their data and aggregate it into what the SEC disclosures could look like. Well, if you gave us those hypothetical SEC disclosures, we could do a darn good job of predicting what the customers will do. And we submitted the paper, and the reviewers came back and said, come on, you're building this model for publicly traded companies, and you have this kind of hokey private transaction log data set. I need you to show me some real public companies. And so we kind of hemmed and hawed, and that was the onus for finding Overstock and Wayfair in the first place. So the second version of our paper had Overstock and Wayfair, which were really the first two companies that we found that disclosed a good amount of customer data. Ran the numbers. The numbers for Overstock implied a very normal valuation. It was pretty much where the company had been trading at the time. With Wayfair, though, no matter how we cut the numbers, we always ended up with valuation estimates that were far below the then current stock price. And we tried to be as optimistic as possible about every other assumption in our model, margins and, working capital needs, et cetera, et cetera. But no matter how we cut it, those were the numbers. And so, we didn't feel good about it because in some sense, then we're kind of disputing the efficient markets hypothesis. But we said, as a scientist, I can't put anything else in this paper besides what I genuinely believe to be true. So, so we put it out there, and essentially the next day, a famous short seller began to tweet about the paper, and it just led to this veritable flood of downloads and controversy. That the stock had fallen on the order of 9% in a day, which was at the time it was the largest stock price decline in a year and a half. And then the sell-side equity research analysts jumped in, and we were getting phone calls from them. We ended up on conference calls with a number of hedge funds and other firms that had been, at the time, large owners of Wayfair. So it ended up on Jim Cramer. I'm not sure if you saw the video clip of him, but he had a whole segment on Wayfair and our analysis and what other people were thinking. And his conclusion was, this is a battleground stock, just stay away. So yeah, the whole thing.
But what was the actual problem with the stock for those who don't really understand the stock market and everything? What was essentially the issue with Wayfair?
Yeah, it's very basic. Yeah. Maybe it's easiest to almost contrast it with Overstock. So at Overstock, when they acquire a customer, if you were to compare the amount they spend to acquire that customer, they make about $10 on their acquisition cost. At Wayfair, in contrast, when they acquire a customer, they lose about $10. So essentially, you kind of like with HelloFresh, they're spending a lot of money on marketing, And so they're showing very, very, very strong revenue growth, but at the same time, they're actually showing larger and larger losses at the same time. And the canary in the coal mine is that they're losing money for every customer they acquire. So actually, the more they grow revenues, we would expect them to lose more money. And again, that's going to make it very hard to end up with any sort of reasonable stock price estimate. And that was kind of one of the biggest drivers of our lower fair value.
If you want to understand more about the science behind customer decisions, follow our blog at blog.worthix.com or find Worthix on your favorite social media. Getting your CX project off the ground? Start with the right foot by downloading our CX guides, ebooks, and playbooks on worthix.com today.
And Dan, how do you think all of this impacts customers at the end of the day, and sort of their interaction and experience with these companies as they sort of rise and fall?
Yeah, ultimately it comes down, I think, to how the companies respond in terms of how they handle their customers. And that it depends on the company. So one of the examples that I love to kind of tout is Amazon, actually, that all the way back in I think it was like 2001. They had about 78% of their orders coming from repeat customers, which is just dramatic. It is very high for where they were in their life cycle. And that was a function of their very, very good customer retention. I could imagine other businesses that are more competitive where, perhaps, they don't need to hit the ball out of the park on customer retention if they're able to acquire their customers more cheaply. Other businesses where it could be the cost to serve that's a real differentiating factor. So it's kind of hard to say exactly how that's going to translate into how the customer is treated. But what I can say is that that combined effect of essentially acquisition, retention, orders, and spend, and then the cost to serve is that's ultimately what's going to dictate the company's stock price.
Going a step back to what you were talking about at the very beginning, which is customer centricity, which is something that Pete Fader discusses, maybe dedicated his life to, as you said, and how that ultimately defines the strategies that companies are going to use when acquiring customers, right? So there's, Fader always says, not all customers are created equal, right? How can this be applied perhaps into companies to help them acquire their companies in a smarter way? And maybe that might even justify spending a little bit more, because ultimately in the long run, it's more valuable to the company itself.
Yeah, it's a really important question. And I don't know if Pete had mentioned Zodiac.
Yes, he did.
Yes, I mean, ultimately Zodiac I think it was a way for companies to be able to implement customer-centric business strategies. So there we're getting a bit more tactical. So we're moving a little bit further away from the customer-based corporate valuation work. Ultimately the end goal is the same, but it becomes much more, what do we do with the day-to-day? And what we would say is, let's score every single one of a company's customers. Let's get all their lifetime value estimates using our prediction model, and then just find the correlates of what makes the high value customers better than the low value customers. And that could be acquisition channel. It could be the first category that customers make their purchases through. It could be demographic or psychographic, attributes that they have. Usually those are less important, but you never know. And essentially just using that to dictate how you're going to reallocate your customer acquisition budget in the next period. And I think the very best companies, they do both of those steps very, very well. So they have very good models for knowing how valuable all their customers are, how that's been evolving over time, and then using that to actually take action and adjust their customer acquisition budgets to essentially optimize off of the expected value of acquired customers in the next period.
Yeah. And Dan, we talked a lot today about customer acquisition and growing revenue, et cetera. But think of that in in contrast to keeping customers as well and retention and how those things balance. Because even one of the strategies in terms of driving acquisition also is the hope that maybe our acquisition costs are high, but in the long run, if we think of customer lifetime value, we make it back right down. That may be right or wrong, depending on the business model. But could you talk a little bit about, for our listeners, because a lot of our listeners will be very focused on customer experience. So they'll be tasked with keeping customers in, driving loyalty, reducing churn, et cetera. And the balance between those two things as you're thinking about customer acquisition and driving, even connecting that to valuation versus customer retention and keeping customers happy and continuing to purchase, month after month, quarter after quarter.
No, I completely agree. And it's really this mindset shift that a lot of companies, they purely focus on the cost of the acquisition.
Right.
So CPA is kind of the measure that they'll singularly focus on when they're thinking about their customer acquisition budget. And what we would say is, let's focus on VPA, the value per acquisition.
Right.
And we have seen with previous companies that we worked with through Zodiac that, oftentimes your very best customers may come through more expensive channels. And that's perfectly okay. But it's going to be that second model for the post-acquisition value of the customers that's going to allow you to be able to justify that investment in that more expensive channel. So that's a very important point. And I think going back to the example of Amazon, I think they're a great example of a company that has really been able to expand the value of their customers through retention.
Right.
And at least in my personal experience, it's very hard for me to argue that that's not coming from a great customer experience. So, I've been a customer since 2006. And the reason I keep coming back, both because of breadth and, obviously amazing shipping, but they've treated me very well. They've treated me very, very well. Again, I don't know anyone who is working within CRM at Amazon, but I would be surprised if they don't have someone who's kind of translating those behaviors into some sort of estimate of retention lift.
Right.
Mm-hmm.
Dan, really excited to see the following papers as you start to look into some of the variables that are driving the decision to stay or go, et cetera. And we'd love to chat about that. We have our own opinions about those things. So happy to discuss.
Well, if you're interested, I give you the 30-second version right now if that's something that might
Shoot.
be. Absolutely.
This is what I'm spending all my time thinking about right now. So I'm more excited about this than anything else. It's going after the data sources again. And so one of the examples that I think I would love to see a repeat of this with customer data is the story of same-store sales. That back in the day, there was this analyst, Jerry Gallagher, and he was analyzing this retailer, and he suspected that they had financial issues, but their sales were growing very quickly. And what he suspected was that basically they were opening a lot of new stores, but the sales at existing stores were dropping like a stone. And so he asked the CFO of this company, WT, I think it's WT Granger, can you tell me what the same store sales figure is? And he said it in a different way. And the CFO stonewalled him, basically. So he went out and he cobbled together his own estimate of same store sales and showed it was basically a double-digit decline. The following year, the company goes bankrupt, and everyone wants to know what same-store sales are for many, many, many companies. And so he started to cobble together these estimates of the figures for other companies. And then the company said, I know that the market is basically getting these figures anyway, so we're just going to start disclosing them ourselves. And that's exactly, I think, what we're going to see with the work that we're doing right now. And we have this data from a very large credit card panel from this company's second measure. And even if companies don't disclose enough data in their own SEC filings, the fundamental claim that we're making is if we were to kind of take whatever data that they provide in the SEC disclosures and combine it with this credit card panel, we can make statements about companies that we would have never been able to make statements about before. And so, kind of like with same-store sales, the hope is that companies will realize the gig is up. Even if you don't disclose yourself, we're going to know what your numbers are. So you might as well disclose. But there's a whole lot of statistical magic that we need to do to get it working. And that's where the paper is. But I think
Really interesting.
it has very big implications for marketing.
You're going to have a bodyguard, Dan, I think, if you keep going down this road. Be careful, when you're at the local Starbucks and, anyway, it's fascinating work.
Well, it's great. Becoming the IPO whistleblower.
Yeah, exactly. I love it.
Well, that is one other thing I'd say is we've seen many very good companies actually through kind of some of the diligences that we've worked on with private equity firms. So it's not that all the results have to be negative.
Right,
and companies like Netflix, Dollar Shave Club, they're doing great.
Yeah.
But the ones that stick out in the mind are some of these other examples. So,
well, that's great. It's really interesting work.
Dan, it was great having you. There's so much to unpack in this episode. Great insight. If our listeners want to continue engaging in conversation with you, contact you somehow, what can they do? How can they find you?
Yeah, I'd love to. I'll speak with anyone who'll listen on this topic. So I'm on Twitter. So D_MCCAR, D McCarr. LinkedIn is my primary outlet for social media. So that's where you'll tend to see most of my activities. I'd love to connect. And if you'd like to, please shoot me an email. Daniel.mccarthy@emory.edu. I'd love to hear from you.
Thank you for listening to Voices of Customer Experience. If you'd like to hear more or get a full podcast summary, visit the episode details page or go to blog.worthix.com/podcasts. This episode of Voices of Customer Experience was hosted and produced by Mary Drummond, co-hosted by James Conrad and edited by Nick Gomez. Blog copy and summary by Emma Waldron.